Welcome to another edition of the Chicks on the Right podcast, where we talk to our friend and sponsor of the show, Zach Abraham from Bulwark Capital Management. And today we're going to talk about home ownership, because apparently there was a recent article that said that buying a home now in 2025 is harder than it's ever been. And in fact, when it used to be just 5 years ago, you needed to have an income of about $78,000 in order to be able to afford a typical first-time home. Now it's jumped 50%, where you need to be making upwards of $120,000 while wages have only climbed around 27%. So you combine like all of the high mortgage rates, the high prices, all the insurance premiums, the inventory that's out there right now. And it's starting to feel, I worry for like my kid and for other 20 somethings, that home ownership is like pure fantasy at this point. So what do you think about that? Is buying a home just going to be totally out of reach for like my kid who's going to graduate from college in 3 years?
No. So, I mean, these things occur, right? First of all, you got to look at it on timelines. I mean, one of the things that you have to think about is there's going to be a lot of the baby boomer generation is getting older every day, right? And more of them are becoming retired. I think something like 11,000 of them retire every single day. Now is the pace that you're on or something. Yeah, it's pretty crazy. But then you think about it and you're like, it's the baby boomer generation, I believe, is like 80 million people. So, that's a big chunk of people. But anyway, as they age and as they downsize, as they pass away or whatever, or move into assisted living and all that kind of stuff, that's going to free up a lot of inventory. But what I do think, though, is that if you're younger or you're trying to purchase a first home, the first thing I would say is be very mindful of where you're doing that. Right. For instance, if I had kids that were of that age, now I wouldn't want them to. I want them to live right across the street from us. Right. If I had my way, but I would tell them, hey, I don't have a problem with you paying up for a home, but where are you going to do it? Right. Are you trying to do it in California? Well, I think that's really dumb for a whole host of reasons. Not even just speaking politically. Right. Just economically, I think that's dumb. If you were trying to do that around where I live in the Seattle, Washington area, I think that's dumb. I think there are a lot of places, specifically a lot of places in the Midwest, where I think it makes a lot of sense. Go look at home prices in Detroit and the surrounding areas. People are like, oh, it's Detroit. And I'm like, you know what? Well, just like everybody forgets that things cycle, right? So if we went back to the 70s and we said Detroit's going to turn into a ghost town after 2008, people are like, get out of here, right?
Right.
If we'd have gone back 10 years ago and said Detroit's probably a great place to buy land, people are like, Detroit, it's a black hole, right? Well, look how much the land values have bounced up. Detroit is there for all this. Detroit was a big deal because of where it was, right? Located on the Great Lakes, shipping lanes, all of those reasons still exist today. And one of our biggest macroeconomic calls is, look, I think you're going to see a reverse of what we saw for the previous 25 years, where you saw a migration toward the coast, right? I think COVID snapped
I'm one of
that.
those people.
Yeah, there you go, right? I think COVID snapped that, and you're going to continue seeing people push inward, if no other reason. And everything feeds into it, right? So, like I said, baby boomers retiring, that feeds into it too. Why? Cost of living. You can sell your place, in the Seattle area, move to somewhere in the Midwest, and pay cash for your new place and stick another 400 grand in your pocket, right?
Yeah, that's right.
It's tax free, by the way, right? So that's a big deal. Now you've got a paid off house and 400,000 sitting there that's throwing, at 4% interest rates is kicking you $1,200 a month, right? So I mean, think of that swing. Same with young people, right? Technology has made work from home so much easier. Well, if you're a tech company or you're any kind of company that isn't, that you don't need somebody geographically there, think of how much more competitive it is. If you want to hire somebody to come work for you in San Francisco, you've got to pay them 180, 200 grand just to get in the door. They won't be able to feed themselves, right?
Right.
Well, that tech company can say, hey, you can do this job from Omaha, Nebraska, and we'll pay you 140 grand. Well, that guy's living like a king in Omaha. The tech company's saving 60 grand. So getting back to your original question, I don't think it's a blanket yes or no. What I would say to young people, though, is if you look at the experience your parents, for instance, if they were looking at what my real estate performance has been since my wife and I first bought a house in this area, I would look at them and say, don't count on a repeat of that for you. And part of that is just you're buying houses at a record in affordability, right? So it's not a good time in the long run. So I would say don't press it. You don't feel like it's something you have to do. Here's another thing that rents have now pulled back down to where they're less than mortgages. So
are they? Because I wondered, what made that happen? Because when we were leaving Indianapolis and there's all these new apartment buildings going up and we were just like, what is going on? But then we would look at the rent rates and they were insane.
Yeah. So again, it's going to be location dependent, right? Because if you've got a small city and a bunch of people there are moving there for a specific reason, rents are going to go up. But generally speaking, rents will go down, and they have started receding in most parts of the country. And what is driving it is actually something that isn't a very positive thing, meaning it's kind of something we're keeping an eye on. We're getting a little bit worried about, which is there's just been an overbuilding of multifamily homes. Okay. And the best way to describe it, it's different. It's not the same thing, but people are like, really? And I'm like, yes. So a lot of the people that got killed in the last downturn in real estate in 08, 09, a lot of those folks decided they were going to play it safe and not speculate in individual homes anymore, but they're going to do multifamily. Okay. And then as markets went up and more money started pouring into private equity and things like this, you've gotten to the point where we think that there's a lot of places where you've overbuilt multifamily homes. And if you look at what's scheduled to be delivered in the next year to two, as far as multifamily homes, it's going up a lot. So there is a backlog. So I think you're going to see continued downward pressures on rents, generally speaking. And I think over time that will be beneficial on the housing market. And what I would tell young people right now is I would say, look, find the best rent scenario you possibly can and sack away money and invest money and buy a home when there's a good opportunity. People are like, oh, well, rent's throwing money away. Anybody that said that hasn't owned a home. Okay. Because right. The reason homes are good investments, they're really not when you look at the rate of return. The reason they're a good investment is because you lever them. Right. So meaning if you just put traditional money into it, it's not a very good investment. I mean, you got to pay out, repairs, fixes, property taxes, all these other things. The leverage is what makes it good. So what I tell people is there's a lot of economic, for instance, I moved into a new house. It's not new, but new to us, but moved to a new house in February. A month and a half ago, I had to replace a furnace. That was $20,000,
Right.
Like that's the part of it that nobody talks to you about, So there are advantages to renting. And if my thing would be this, if you feel like it is a big stretch, if it feels intimidating to pay that mortgage amount, if it feels don't do it. Don't do it. That's your answer, right? Stay out of that, because if the mortgage is oppressive, when the repair bill hits, it's going to be crippling, and you're much better off investing the money, saving, and waiting for an opportune time, because it will come.
Okay, that's interesting, because I wondered if the rent versus homeownership thing was analogous to, leasing or buying a car. But it sounds like in this situation, because isn't it always better to sort of buy the car versus leasing it? Or is it because leases, when you lease it, you always have a new car, but like you never have any ownership. You're basically renting a car forever.
Yeah.
Is it the same, or are they totally different?
No, there's definitely some similarities there. So whenever we're talking about houses and cars, one of the things that we have to step back and say is, okay, look, it's why I hate it when people are like, the home's best investment you're ever going to make. And I'm like, well, it might be your best investment, but it's because you haven't invested well, right? Like,
right.
You know what I'm saying? Like, it shouldn't be, right? If you're going to be at a really good spot financially, that should not be the case, right? Your 401k should have done better. But the one thing that we have to look at is housing and transportation. We have to pay a cost for that no matter what, right? It's a baked in cost. So the good thing is the house does appreciate in value over time, right? So is it better to own a house than to not? Yes. Okay. Is it is it so much better? Are you killing yourself if you don't do it? So you're going to put yourself in a situation where, and even if you can get financed, I don't even know what the financing standards are, but is it so important you should put yourself in a scenario where 55 to 60% of your take-home pay is going to pay your mortgage? No. Okay. Like that's not a good decision, right?
Mm-hmm.
So it's not, yes, own a house at all costs. The benefit of a house is when you get to a point where you're like, okay, that's a reasonable mortgage payment. I can pay that, no problem. And should I rent or should I buy? Well, you should buy because it's going to add up over time and you're going to get part of the money back. And there's tax advantages and things like that. But when you're tight, you'd be much better off fixing yourself financially, saving money, saving for a bigger down payment. That's another thing too. Build that down payment. When people are worried about rates, if you're worried about rates, put more money down, save more money. And they're like, well, we got to do it now. Well, wait a year, wait 2 years, whatever money you put down, you're not going to be paying that interest rate on. So
I would think that the fights that Donald Trump is having at this point with Jerome Powell, I would think that we're going to see some rate decreases by the end of this year, don't you? I think you're going to see at least one, if not two cuts. My guess is that you're going to see probably 50 to 75 basis points of cuts. Put a gun to my head, I'd probably say 50. Here's the problem. That only affects the very front end of the curve, right? The Fed does not set interest rates on the 10-year treasury. That's set by the market, right? So one of the things that I think you have to be careful on is if you cut rates and inflation picks up, it is entirely possible that even though you cut rates, mortgages could go the other way. Really?
Yeah. Yes. And it's something that they need to be very careful about. And this is one of the things that I was like, that if you put me in a room with Trump and I got to tell him something, I'd be like, hey, I understand your frustration and I don't think that you're entirely wrong. Part of Fed policy, when they cut, how they've cut, it does smell a little bit fishy. To be fair to them, though, here are the reasons why you can defend what they're doing. And he's calling for 100 to 200 basis points of cuts in an environment where unemployment's at 4%. The S&P 500 is at an all-time high, trading at 30 times earnings, and you have record in affordability and housing, right? And the chief reason you have record in affordability, guys, 6.5% mortgages are not historically, usury, right? That is still historically a very low mortgage rate. So the reason that rates are not helping, but let's also look at what housing prices have done. Right? They've gone nuts. I mean, you had even including the financial crisis, we never saw housing up 50% in like an 18-month period of time, right? So you've got to be really careful about juicing this thing too much. You still have inflation at 2.7, right? And you got inflation at 2.7 with $60 oil, right? So you start getting, you start cutting rates and pushing houses prices back up and you get a pop in oil, all of a sudden you're looking at 4 or 5% inflation again and you got to raise rates. So I don't completely disagree with what Trump's saying. I think there are many things that would be aided by lower interest rates. At the same time, you usher in some real threats. And if you get a scenario where you cut, inflation goes back up, and the yield on the 30-year heads north of 5, you're in a really, really nasty, tight spot.
Well, Trump should be taking advice from you. And so should everybody that's listening to this podcast. And how can they do that, Zach?
Yes, well, I appreciate that. Best way to do it is go to bulwarkcapitalmanagement.com and look for the Know Your Risk podcast. We do a daily show covering everything important that's gone on in the markets and economics and politics if it impacts markets and economics. And goal is to make it 25, 35 minutes and every single thing that you need to know from that day that relates to finance and economics. So not tough to find. Just Google Know Your Risk podcast, bulwarkcapitalmanagement.com.
Always great. I always learn something. Thank you, Zach.
Thank you so much.
Investment advisory services offered through Trek Financial LLC, an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ. Investments involve risk and are not guaranteed. Past performance doesn't guarantee future results. Trek 24308.